Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. We are right here navigating the penultimate trading day of 2025, and our deep dive today has a really critical mission. We need to unpack these conflicting signals that are hitting the market from all sides. We're talking about extreme, almost historic volatility in precious metals. We're looking at the tension in biotech between, scientific potential and sheer market impatience. And then there's China's incredibly aggressive industrial push into chips and robotics.
It really is a day defined by a global holding pattern, which, that's a signal in itself as we close out the year. Over the last 24 hours, U.S. stocks generally dipped on Monday.
Right, kind of did put a damper on what was left of that Santa Claus rally.
Exactly. The S&P 500, the Dow, the NASDAQ, they all saw some cautious profit-taking, slipped about 0.5% across the board.
And internationally, it looks like Asia-Pacific markets pretty much mirrored that caution earlier today. I saw the Nikkei was down, the Kospi was down. Seems like they're still citing those jitters over, the AI bubble fears.
They are, though interestingly, Hong Kong was the outlier. The Hang Seng actually managed to climb, 0.86%, a solid rise?
It was, yeah.
But the real reason for this inertia, the thing that's keeping traders on the sidelines, is the Federal Reserve. Everyone is just laser focused on that 2 p.m. Eastern release of the minutes from the December Fed meeting.
And that meeting was a big deal. It cemented the third quarter point rate cut of the year.
That's right, pushing the federal funds target range down to 3.5% to 3.75%.
Okay, so help me out here. We already know the decision. Why do we care so intensely about the minutes of a decision that's already been made?
Because the devil is always in the details of the internal policy split. The sources, like CNBC, are suggesting this rate cut was way more contentious than the market reaction at the time implied.
So you're looking for the fractures in the consensus.
Yeah. Exactly. We need these minutes to gauge that policy debate. Who was pushing for more easing to protect the labor market? And on the other side, who was worried that policy was getting too loose and risking a return of inflation in early 2026?
Right, and that debate is what's going to set the tone for the first quarter of next year.
It will determine the entire trajectory, and you can see that uncertainty reflected in the Treasury market.
Yeah, CNBC noted it was pretty stable there. The 10-year yield was flat around 4.12%.
And the 2-year dipped just a tiny bit, and this is where we connect the dots for you. Remember that yields and bond prices, they move inversely.
So when the 10-year is flat like this,
it means investors aren't willing to take a massive risk on either side. They're not panic selling bonds, but they aren't aggressively buying them either. It just points to this deep market caution, even with the generally bullish story for 2026.
Okay, caution in the bond market, I get that.
Yeah.
But if you look at precious metals, and especially silver,
wow,
caution is the last word I would use. This was a dizzying, wild ride. It just defines the market's anxiety right now.
Oh, it was dramatic. Both CNBC and Bloomberg were all over it. Silver first hits this record high, above $80 an ounce, overnight into Monday.
And then what happens?
It promptly plunges over 7%. That's its largest single-day drop in nearly 4 years.
And then, just to keep everyone on their toes, it soars 5% again early Tuesday.
I mean, you can't make this stuff up.
A 7% drop in hours. That's a move you usually see over months. What on earth is fueling this? The year-to-date gain is already, 153%?
It's a collision of macro anxiety and, this is the key, concrete industrial demand. It gives silver this dual character that gold just doesn't have right now.
Okay, so break that down, the macro side.
Well, on the macro side, as Bloomberg reports, precious metals are getting a boost from, subdued geopolitical tensions. There's also uncertainty around the Fed's independence, especially with President Trump's rhetoric on trade and policy.
So classic safe haven demand is high. But you're saying the industrial angle is what's making the volatility so extreme.
Exactly. Silver isn't just something you buy when you're scared. It's critical to modern tech. Solar panels, data centers, EV batteries.
I even saw Elon Musk posted about it on X.
He did. He noted its necessity in, quote, many industrial processes. Now, that tweet didn't create the demand, but it certainly put a spotlight on the underlying scarcity that fuels these run-ups.
But the real tipping point, the thing that drove that spike over $80, that was pure speculation, right? Heavily focused in Asia.
That's where the fever really built. It was fueled by this elevated speculative buying in China that pushed the London-Shanghai silver premium to a record high.
And why does that premium matter so much?
Well, that premium is basically the price difference between those two giant markets. When it widens that drastically, it means domestic Chinese demand is just aggressively outstripping the rest of the world, and it's often driven by speculative funds just hunting for massive leverage.
And the risk got so high that I read one Chinese silver fund actually had to turn away new customers.
After repeated risk warnings, yes. I mean, that is a textbook sign of an unsustainable, speculative bubble building.
So what happened? Did the market just correct itself?
The market's mechanisms tried to. Technical indicators like the Relative Strength Index were screaming that the metal was extremely overbought. But more importantly, the CME Group stepped in.
What did they do?
They raised the margin requirements on silver futures contracts starting Monday. It's a classic move to de-risk a market.
It forces the highly leveraged traders to either put up more cash or just sell.
Exactly. And Yahoo Finance noted that directly contributed to that sharp corrective sell-off on Monday. The CME basically forced a correction by making it too expensive to hold those positions.
But does that really cool the market long term, or does it just push the risk somewhere else?
It forces a temporary pause for sure, but the underlying supply pressure is still critical. You've also got this looming threat that China, a major silver mining country, might restrict exports starting in January.
Which would just tighten the supply dynamic even more.
Right. It means any future speculative surge will hit an even shallower supply pool, and that could lead to even more violent price swings.
Speaking of volatile prices driven by unexpected industrial demand, let's pivot from metals for solar panels to the miracle drugs that are shaking up the entire healthcare economy. GLP-1s. The tension here is a fascinating study in the disconnect between, the long-term science and the short-term market impatience.
The tension is palpable, and you can see it with Novo Nordisk. Their stock is having its worst year since listing. It's down 50% from its peak in mid-2024.
And that's being driven by competition from Eli Lilly's Mounjaro and Zepbound, and the patent cliff is getting closer.
Right, 2031 and 2032. Jefferies analysts basically said they see no real moat for Novo heading into that period. That financial pressure is forcing them to find new applications, and fast.
Which brings us to this growing list of beyond obesity benefits.
Precisely. And if you connect this to the bigger picture for a second, the medical community is realizing these drugs aren't just for weight loss and diabetes, they're already approved to dramatically cut the risk of heart attack and stroke. And now, observational data is showing promise for kidney and liver disease.
But the biggest reveal, and the thing that could be the biggest social disruptor, is the brain connection.
Yes. The idea that these GLP-1s act as anti-consumption agents.
So what's the mechanism there? What's actually happening?
Observational studies suggest they're affecting the brain's reward pathway. By modulating signals in the brain, they seem to curb cravings, and that effect looks to be universal.
Not just for food.
Not just for food, potentially for alcohol, tobacco, recreational drugs. I mean, researchers are positioning these drugs as something that could fundamentally shift consumer behavior away from highly rewarding substances.
If that holds true, this isn't just big pharma anymore. This is a radical social and economic disruptor.
It really is. And yet, despite that huge potential, the stock took a hit recently over the Alzheimer's trial results. The market reacted badly.
But the scientific community basically said, hold on a minute.
That's the key nuance we have to highlight. The late-stage trial failed its main goal of slowing cognitive decline in Alzheimer's patients. Stock drops 5.8%. But scientists stress this was not an outright failure of the drug's mechanism.
Okay, so what did it show?
Biomarker measures showed the drug was successfully impacting Alzheimer's-linked proteins and reducing systemic inflammation.
So the implication isn't that the drug doesn't work, but that by the time patients get to that late stage, the disease is just too far gone for the cognitive decline to be reversed.
That's the exact takeaway. The scientific perspective is shifting from a late-stage cure toward early prevention. This trial perfectly illustrates that friction between long-term, iterative biological research and the market's demand for an instant win.
And that pressure is also heating up the global competition, forcing price wars.
Absolutely. The need for market share is driving huge price cuts. Reuters reported both Novo and Eli Lilly are cutting prices significantly in China Wegovy prices, slashed by up to 48%.
Wow.
And at the same time, Novo is gearing up for an Ozempic launch in India. It's a massive push into emerging markets to offset that domestic competition.
Speaking of aggressive global pushes, let's connect the volatility of industrial inputs like silver to the supply chain volatility being driven by China. We are seeing incredible acceleration coming out of Beijing's tech sector. starting with the rates for the humanoid robot.
Yeah, China has made humanoid robots a strategic national priority. It's written right into their 15th five-year plan. And analysts suggest China is leading the early commercialization phase. Maybe not the pure R&D, but the getting it to market part because of their manufacturing capacity and, frankly, their demographic pressures.
An aging population and labor shortages.
Right. And that focus on rapid commercialization, not just prototypes, seems to be driving production capacity incredibly fast.
What kind of numbers are we talking?
Right. Well, UB Tech, for example, is planning to deliver 5,000 industrial humanoids in 2026. And the EV maker XPeng just debuted its second-gen humanoid, Iron, and they're planning mass production next year.
But the cost hurdle is still the elephant in the room. A prototype costs, what, between $150,000 and $500,000?
Yeah, that's not replacing factory workers just yet. They need to get that cost way down to between $20,000 and $50,000 to really be competitive with human labor.
And this aggressive ramp-up has already triggered warnings from within the Chinese government itself.
It has. The NDRC, their top economic planning agency, warned of a potential bubble.
What are their specific concerns?
Too many companies, over 150 of them, making similar products, and there's this huge gap between the polished demos you see online and what the robots can actually do in a real messy factory environment.
So if the government is already worried about a bubble, doesn't China risk destroying its own advantage through oversupply before the tech is even proven?
That's the core tension. They prioritize speed and scale, but that often leads to inefficiency and, well, duplication. But then you look at their policy on semiconductors and you see how they enforce self-sufficiency no matter the cost.
They aren't just pursuing chip self-sufficiency. They're literally mandating it.
Exactly. Reuters reported that China is now requiring chip makers to use at least 50% domestically made equipment for any new capacity. The long-term goal is 100%.
And that forces manufacturers like SMIC to prioritize domestic suppliers.
It does. They have to use companies like Nora, which is now testing advanced 7-nanometer etching tools. So this policy is just fast-tracking the deployment of advanced Chinese tools much faster than anyone anticipated, even where foreign alternatives are, better and available.
If they successfully mandate this, it fundamentally redraws the global supply chain maps. It also locks in demand for those industrial inputs like silver.
It signals that Beijing is serious about structural change, even if it creates short-term friction. And that same structural shift is happening in their EV market, which is now facing a survival test in 2026.
Why a survival test? The growth there has been phenomenal.
The problem is that the growth rate is expected to have next year, down from about 20% this year. It's domestic saturation and just brutal price competition.
And consolidation is happening fast.
Very fast. The top 10 manufacturers now account for about 95% of the market. Even the leaders, BYD and Tesla, saw their November sales decline.
And that intense domestic pressure is what's fueling this aggressive international expansion. They're bringing the fight to Europe.
Absolutely. They're moving overseas for better profit margins. BYD is building a factory in Hungary. Geely quadrupled its EV exports in the first half of the year. They're using their scale to challenge Tesla directly in its key European markets.
Before we zoom out, just a quick mention of the AI M&A in the robotaxi race.
Yeah, on the M&A front, Meta acquired the Chinese-founded AI startup Manus, a source valued at between $2 and $3 billion. And SoftBank is making a big AI infrastructure play, buying DigitalBridge for $4 billion.
And Waymo.
Waymo is gearing up for its most aggressive expansion yet in 2026. They're targeting 20 new markets, aiming for 1 million rides per week by the end of next year.
To do that, they're going to need a really compelling safety narrative to get regulatory approval.
And they have one. Waymo's own data shows dramatically lower crash rates involving serious injury than human drivers. It's something like 0.02 crashes per million miles compared to 0.23 for humans. That safety record is going to be essential as they try to enter dense cities like London.
Right, flipping now to the macro outlook. Let's talk risk versus reward. Wall Street strategists seem almost universally bullish for 2026.
They are, predicting a fourth straight winning year for the S&P 500. A Bloomberg analysis shows the average target implies about a 9% gain.
The optimism is widespread.
It is, fueled by resilient growth, cooling inflation, and those projected Fed rate cuts. Ed Yardeni is the most optimistic. He's calling for the S&P to finish at 7,700.
You know, when everyone agrees like this, shouldn't we start to worry? That usually signals peak complacency.
That is the classic counter-argument. As one analyst at CIBC put it, people are sleeping on a lot of macro risks.
What are the main ones?
The big ones are the Fed holding rates steady for longer than traders expect, or some new geopolitical shock. And this is where Jim Cramer's guide becomes relevant. He's recommending you buy secular growth stocks.
The ones that can grow regardless of the economy.
Right. Strong revenue, low borrowing needs, high scalability. Basically, he's talking about the Magnificent Seven.
Which brings us right back to the most unpredictable macro risk: political overhangs. And the Fed drama with President Trump continues.
It does, and that threat to monetary policy independence is very real. President Trump continues to talk about potentially firing Fed Chair Powell, calling him incompetent. He even mentioned an upcoming announcement for his preferred candidate in January.
And Powell's term as chair is up in May 2026.
It is. So this whole dynamic just adds another palpable layer of uncertainty to monetary policy next year.
And globally, we saw two major geopolitical flashpoints flare up, which further justifies that flight to safe haven assets we were talking about. First, Russia and Ukraine.
Yes. Russia alleged a massive 91 drone attack on Putin's residence. They claim it was all destroyed. Ukraine, for its part, vehemently denied it. They called it a complete fabrication designed to undermine the recent peace talks between Zelensky and Trump's team.
And Trump's response.
According to CNBC, when asked about it, he appeared to side with Russia, saying it wasn't the right time to attack Putin's house.
And second, the simmering tension with Iran.
Following his meeting with Israeli Prime Minister Netanyahu, President Trump threatened to, and this is a direct quote, knock the hell out of Iran if it tries to rebuild its ballistic missile program or restart its nuclear program.
So this aggressive rhetoric highlights that profound geopolitical risk that is actively driving demand for assets like silver, even as Wall Street stays universally bullish.
Exactly. It's a huge disconnect.
So what does this all mean for you as you're trying to make sense of this? The striking contrast that defines this final week of trading in 2025 is just that. Widespread Wall Street optimism for future gains running headfirst into a simultaneous surge in safe haven assets, all underscored by these escalating geopolitical tensions and structural policy uncertainty.
And that leads to a final provocative thought for you to carry into the new year. As you process all this data, here is the structural shift to keep a really close eye on. China's relentless push for domestic self-sufficiency. This isn't just a political talking point anymore. We've seen the hard industrial policy driving silver, chips, and robotics. So think about how that accelerating mandated domestic production will fundamentally redraw global supply chain maps much, much faster than most current market models are predicting.
A lot to chew on as we close out the year. Thank you for the deep dive.
Always a pleasure.
We'll see you all tomorrow morning with new headlines from major financial magazines.